From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for February 6th, 2026. Here's what's happening. The Bucks play the Indiana Pacers tonight at Fiserv. Then at State Fair Park, it's the Pet Expo where you can meet adoptable pets from 10 to 5 on Saturday. All the money raised goes back to the shelters and sanctuaries, so that's really cool. Well, here we go. A North Carolina man faces multiple felony charges for breaking into a Little Caesars Pizza after closing time last Sunday. He turned on the lights, fired up the ovens, and began making pizzas and selling them. But he kept all the money, and that's the part that got him into trouble. A Florida man is charged with stealing $4,000 worth of meat from 2 grocery stores. Then he trashed all the meat after he got to his girlfriend's house and found her cooking with another man. I think that might be a new definition for cooking. And on Sunday, maybe you're hosting a Super Bowl party. If you are, here's a must-have. A new Heinz 7-pound keg of ketchup. It's a 20-inch stainless steel beer-styled keg with a spigot. I'm not hosting a party, but I just want one of these. On the podcast today, we have Mike Hoelzl, Tom Pappenfus, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. Normally my kids are not probably tuning into the open, but both the Adopt-A-Pet and the ketchup would probably catch their attention, so I'm hoping they're not listening.
Call my attention. I mean, I'm in.
An interesting week overall for the markets. Interesting, maybe an understatement. NASDAQ, a really, really tough time getting traction, down 1.8% this week, closing at 23,031. The S&P just about flat, down 0.1% or 7 points on the week, closing at 6932. And the Dow Jones Industrial Average, after a 1,207-point rally on Friday, finished the week up 1,223 points, up 2.5%. to close over 50,000 for the first time for the year. NASDAQ down 0.9% now. The S&P up 1.3% and the Dow, after a stellar 2.5% this week, up 4.3% on the year. You know, Mike, it's hard not to look at this massive, massive transition that seemed to take place this week. A lot of conversation around what was happening with software and artificial intelligence more broadly. But really, it seems to be coming back to a market that up a little, down a little. Really tough to predict day-to-day where we're going, but overall, it's been somewhat positive even to start this year.
Yeah, again, I've used this word in the podcast before, but I think this year is going to be just kind of messy. I wouldn't even use the word volatile. You've got some good fundamental numbers, but also you have some other kind of outside noise, but it's really nice to see kind of the market breadth like widen out, so it's not just these magnificent 7 tech companies that are driving returns. You're starting to see more participation, which you want to see. And that's not to say that necessarily like we're like a tech bubble has popped or anything like that. It's because those companies are still doing well. But some of the things that I've heard of, like maybe why the NASDAQ isn't keeping up with the Dow or the S&P is with the valuations as high as they are for those tech companies, that's a place if you want to take some money or kind of reduce some of your risk for the year, that's a place where people are taking them because it's the classic sell high philosophy. So yeah, it's nice to see the Dow, which again, we like to remind people, Kyle, you do a good job of it, is saying it's only 30 stocks, but it is nice that they are having the start to the year that they are. And so I hope that continues, and I would expect at some point the NASDAQ, maybe not catch up, but to kind of hold up its end of the donkey, so to speak, with the rest of the market.
Yeah, not to bring it back to the catch-up conversation earlier,
but
perhaps
do.
The NASDAQ will. I think the Dow is such an interesting conversation because, to your point, it is just such a small number of names. I mean, you think McDonald's closes one restaurant in the middle of a freeway in Chicago, and perhaps all of a sudden you've got the Dow moving in a way that isn't really reflective of the broader market. But, Tom, I think one of the interesting things about what we're seeing from the Dow this year versus the NASDAQ is it may actually be a little more representative of some of the breadth we're seeing, that it isn't strictly the Mag 7, it isn't strictly a small number of names. or even a particular sector, but some new things potentially that are in play as investors look at the market more broadly.
Yeah, I mean, I think the other thing that's happening right now is not just the Dow Jones Industrial average, but also the Dow Jones Transportation average is up this year as well. And that tends to be a very positive indicator. Think of transportation, flights, trains, freight. Those are all signs of economic movement. And so we have a number of things working for us right now, and it's not just, as Mike notes, all about technology, artificial intelligence, which I think has just become a bit exhausted right now due to valuations. But now people are rotating into other areas of the market that have been overlooked and kind of undervalued for a long time. And so, as we noted already, market breadth is widening. It's a very positive sign for markets, a very good sign for a healthier market. It tends to lead to less volatility, more stability. So very encouraging things. I mean, I think as people get worried with, geopolitical risk potentially increasing and valuations being high, and you kind of seen the S&P get really stuck on getting past that 5,000 number? No, 7,000, excuse me, where it just has really struggled to make new highs. That you're seeing people look for other areas to find safety, and I think that's leading to ultimately better risk-adjusted returns for everybody out there. So I'm really encouraged by what I'm seeing, even though as clients are talking about things that are concerning. There's areas of the market that are very attractive right now.
And this was a week in which we had a pretty big headline in the AI space. This idea that potentially the enterprise software systems that so many big firms rely on, created by software service providers, well, we might be able to replace some of that innovation or some of that work with what artificial intelligence can do. And it caused a lot of those software companies to see a pretty significant sell-off. By middle of the day Thursday, you had a lot of people looking at those businesses and going, well, okay, maybe our best case scenarios are out the window, and maybe now we're looking at some of those worst case scenarios. I was encouraged that at least Friday, and especially late in the day Friday, we saw quite a bit more stability. It is a sign, I think, that, Mike, you pointed out it's going to be messy. I think markets are going to over-respond to some of that AI news the way we did same time last year when all of a sudden China came out with an AI model that was supposed to be more efficient. We had this meaningful sell-off in the span of a day. We had seen the largest market cap decline for any stock ever in history, NVIDIA shedding more than $500 billion in market cap in a day. This time last year, it wasn't quite that significant this week, but it felt similar to me in terms of how bad that sell-off was, and so encouraged that we saw some stability. The one area maybe we haven't seen that stability is in some of those alternative investments, and in particular, Mike, looking at some of the volatility we've seen in cryptocurrencies and precious metals and areas that I think maybe investors need to be a little more cautious.
It's very interesting with last year, kind of gold and silver having the year they had, Bitcoin up until around October of last year having the year that it had, that I've gotten more questions from clients about, should I be in this? And my answer to the vast majority of them, mainly in retirement, is no. Pretty soundly no, because of the volatility, right? You also look at kind of, let's just take gold, right? Because gold has had a really good year, but it's taken a dive down. Like, what drives gold performance, right? I mean, if you look historically, let's just say over the past 10-ish years, COVID drove it because, people got scared out of their mind of what was going to happen with the stock market. You have geopolitical risks, and some people still believe we're going to go back to the gold standard. I'm not one of them, but that's okay. Different conversation. And then inflation spikes. And what have we been talking about for the past roughly 3 years? Inflation has dominated the conversation. So of course gold's going to have its, time in the sun. But again, they're wildly volatile products to invest in. And so if you are retired, it's not necessarily the best thing to invest in. Now, if you want to put a very small piece of your portfolio into some precious metals or something like that, that's not going to break the overall portfolio, that's not the end of the world. But also, you're seeing Bitcoin, I believe it's down half its value since October of last year. That shouldn't be a shock to people. that a holding with zero tangible backing is volatile and down 50%. Color me shocked that happened. And if you can't see my face, because this is not a visual medium, everyone, I'm feigning I can't even put into words how not shocked I am that this is happening.
Well, and I think we need to be clear that this is perhaps not the "I told you so" moment. Certainly,
it can be for me a little bit.
Certainly, we have
Give me this one, Kyle.
We have been beating the drum that we prefer fundamentals. We prefer those things that have some case that can be made for them that's based on something beyond just what we call the greater fool, right? This concept that somebody needs to be a bigger fool than I am to pay more for it than what I'm willing to pay. And I think Bitcoin certainly falls into that trap. But Tom, gold was the thing that I think a lot of people viewed as the safe haven. And I think perhaps we've gotten the reminder that even those things can have more volatility than what most people expect.
Well, it's certainly a safe haven until enough people look at it as a safe haven, and then enough people pile in thinking that it's looking at the past returns and believing that it's more than just a safe haven. Now it's a speculative or a large opportunity, and that changes the whole reason you went there in the first place. So that's exactly what Mike pointed out that we're seeing right now is just gold going up over 100% in the past year is atypical, very atypical of prior returns. And now you're seeing it go down just as quickly. So you're at the point now where a lot of people have piled in and they keep piling in, and you're not going to get the results. You're not going to get the same historical, basis or type of performance that you're used to seeing, and some of it good, some of it bad. So again, everything in moderation. Anything speculative, even kegs of ketchup.
We're not moderating that at all. I will put ketchup on my ketchup if I can.
I think it's a reminder that the return experience for things like gold historically has been quite chunky, right? That it comes in these spurts, and we have seen one of those spurts. It does not mean that it will simply stop because there's some volatility now, but I do think it's the reminder that, as you rightfully point out, Tom, there has to be some balance to the way we go about adding those things.
Well, and I would even add it's not dissimilar from the trade or investment in energy right now, utilities, if you will. I mean, that is an area people are in for dividend and yield, and now that you've seen returns like you haven't seen in decades. So now it becomes more attractive because of the opportunity. People are looking at historical returns. You're going to get new players into a space that aren't typically there and not there for the right reasons, and it becomes crowded, and all of a sudden you start to see volatility increase, and again you start to see performance and behaviors that are atypical from what it's typically invested in for.
Well, and I'm happy to report that it doesn't appear the government spending bill is going to have to be part of the conversation on, okay, are we fiscally going to be responsible, or are we going to keep paying our bills rather? And so maybe gold backing off a little bit because of some of that. Certainly some concerns over the next Fed governor were part of why we were looking at those kinds of things as places. And at least by early accounts, the nomination or the likely nomination doesn't seem all that far off the mainstream that people are going to be drastically concerned. And so I think a lot of reasons why some of the near-term expectations maybe are tempered a bit more for gold and for some of these other asset classes.
It's very interesting that I believe we're currently in a government shutdown.
Some modified version of a spending bill that will require some additional stopgaps.
No, I mean, I haven't heard much about it. Normally we have these shutdowns and it's top of mind with investors and they're like, what's going to happen? How's the market going to react to it? And we're there and the market's just like, whatever. And it just keeps going because, again, I don't know if they're used to it at this point or investors are used to it or just like, oh, typical Washington, can't get their stuff together. But it is fascinating to me that we're in the middle of this and it looks like the market and most investors could care less.
Dysfunction is normal now.
Yeah, well, certainly it is. And, realistically, for investors, it is so much less about the government's ability to function and so much more about businesses' ability to function that as long as we have meaningful opportunity on the horizon, investors are still going to applaud that. I think a good opportunity to look at some of the economic data. Just briefly, we had some updates from the ISM. Updates on consumer confidence this week from the University of Michigan. Nothing terribly exciting. Tom, anything stand out to you this week in terms of kind of broad data, either economic specific or just markets more broadly?
I mean, just I think the reports generally kind of trend in the direction that we are in expansion territory with the services manager, purchasing managers index. So again, more signs that things are looking pretty stable. It kind of goes back to the debate of should we be lowering interest rates now, getting back to what this idea of what we believe to be a neutral interest rate policy is here. And you're going to start to see, again, as with the topic of a new Fed president coming in the coming months, what kind of policy? Are they dovish or are they hawkish? And what is appropriate for this environment? And again, we're getting mixed data. That's a pretty prominent theme that we've seen now. And, we have largely a strong economy, but we do have a number of layoffs, more reported layoffs here. I think this January for layoffs was one of the worst in the last 15 years, roughly, if I'm not mistaken. So it's again, it's kind of a challenge. Are we lowering rates because we're worried about their a weakening? If you look at employment reports, or do we need to stay still and not lower rates because the economy's doing okay and markets are doing fine?
And I think you add in the consumer piece of that, and we got news on revolving credit. Revolving consumer credit for the month of December, the biggest jump we've seen in more than 2 years. A sign of one of two things. One, people are willing to spend. They're willing to charge the credit card. The vast majority of that revolving debt is credit card debt. Or where they are spending, they have to spend more on the card. And I think it's probably not one or the other. It's probably a little bit of both. We certainly have seen some signs that while consumers don't always feel great, they're willing to spend. And we've seen other signs that one of the reasons they don't feel great is because inflation has taken a bigger chunk out of their ability to spend. And so I think those things all pile on in terms of kind of the broad economic picture. Mike, it's about that time. We've got a big game coming up this weekend.
Superb Owl?
The Superb Owl. All kinds of market implications, or at least some historical perspective on what it might mean. I know we talk sometimes about the AFC versus NFC winning, or the old teams versus the new teams winning, and what that might mean. At the end of the day, this is all obviously
it's all fact.
Well, then
just kidding, everyone.
Well, then let's hear it, Mike. What do you got for us?
All right, so your yearly reminder: if the NFC wins, it is projected to be a bull market. If the AFC wins, it's projected to be a bear market. Now, while it has a success rate of 67% since 1978, year I was born, I'm not taking credit, but the last 10 years it's been 2-8. So it's been off the last 10 years. So it's due for a rebound. So while you can't guarantee any of this, the only thing that can be guaranteed on Super Bowl Sunday is my daughter and I will be dancing to Bad Bunny at halftime because he is phenomenal. I'm just throwing that out there. But yeah, this is all in good fun. You're going to see that if you pay attention. I saw it on a couple different sites this week about NFC versus AFC. While it's all in good fun, like I said, the last 10 years, they've been wrong 8 times. And so just go buy your big barrel of ketchup, buy your guacamole. You'll be one of the people that, what I see, 14,500 tons of chips for this Sunday alone. I'll be participating in that. Go have some fun with it. And then we'll see if the Super Bowl is right predicting the markets this year.
And I think this year's Super Bowl controversy is a boneless wing a wing, as it referred to chicken wings. So
it's an existential question.
With that, we enjoy doing the program for you. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.